There's been a lot of chatter about whether companies should consider switching to a C-corp. Kind of what created that chatter and what goes into those considerations. That's what we're going to talk about today. First, what generated this excitement? That's the Tax Reform Act that was passed at the end of 2017. As part of that act, the corporate income tax rate was lowered from 35% down to 21%. That 14% tax savings makes C-corps much more lucrative. We compare a C-corp tax rate of 21% compared to the individual tax rate of 37%. A lot of more people are considering whether they should switch their flow-through entity into a C-corp. In addition to the tax reform change, there is another segment of the tax law that people are also eyeing with renewed interest, and that's the small business stock exclusion, or the Section 1202 exclusion. What that means is when you make an investment in a small business stock, and there are certain qualifications that the small business stock has to meet, that by and large, if you make that investment and it qualifies, if you hold the stock for 5 years, any gain or a portion of the gain may be excluded from your income. This was intended as a benefit for investors to invest in these small businesses. So as people are now contemplating the C-corp conversion, they can lock in that 20% corporate income tax rate, and if they meet all the requirements of the small business stock, they may get a tax-free exclusion when they ultimately sell that stock. Now, before everyone rushes out to convert into a C-corp, there are other things you may want to take into account. First, if you do convert to a C-corp, think about how you may be able to get the cash out of the C-corp and into the owner's pocket. Keep in mind, C-corps are taxed twice, meaning that the corporation pays 21% on the income that it generates, but when it distributes funds to its owners in terms of a dividend, let's say, that individual is also subject to tax on that dividend, and that's that double taxation. So that 21% tax rate that the corporation pays is actually deceiving, because when you factor in the dividend rate that the individual stockholder pays, the effective rate is actually higher than 21%. Also keep in mind that once you lock your assets into a C-corp, they're a lot harder to get out of the C-corp. And what I mean by that is, if you do want to convert back into a pass-through entity at some point in the future, or distribute assets out of the C-corp, either one of those are typically taxable transactions. Thus, anything you put into a C-corp, that appreciation will be taxed or double taxed by the C-corp before you can get it back out. So before you rush in to do anything, make sure you consult with your tax advisor what makes the most sense for you and your business.